Good morning, good afternoon, and a very warm welcome to this global executive dialogue on the global economic outlook, which is part of our Sigma series. My name is Anthony Kennaway, and I'm the Head of Public Affairs and Stakeholder Dialogue here at Swiss Re. And I'm delighted to be joined today by the Chief Executive of our Corporate Solutions business, Andreas Berger, and our Group Chief Economist, Jerome Hegerle. Gentlemen, welcome.
Thanks, Anthony.
Thank you. I think the last time we were together was in early September, and we were talking about the World Insurance Sigma. And I think one of the constant themes there was one of change. Nothing has changed in that respect. It's all change in the global economy at the moment. And so today what we wanted to do was to get into what the changes have been since that time, and also what the changes are likely to be in 2023 and 2024. So without further ado, let's get into the conversation. And Jerome, let's start with you. So what's changed in the global economic outlook since we last spoke?
Well, thanks a lot, Anthony. Pleasure to be with you, and looking very much forward to a very interactive Q&A at the end. So what hasn't changed is if you look at the mountain, right? And if you picture a mountain, what hasn't changed, it's going to be cold out there. That hasn't changed, but it's like in the mountain. The weather, it can change pretty quickly. And if you think about our forecast, and if you look at our last Sigma outlook that we just published last week ago, yes, maybe probably we had seen peak rates, we have seen peak inflation. Maybe we also have seen peak pessimism. That's a good thing, but it doesn't mean we should become optimistic, right? I think if you look at our forecast, yes, inflation recessions, they are still in the making. Yes, we had seen better than expected Q3 prints last quarter in Europe, in the US. Exception at this stage is the macro dynamics we see in China. It's worsening. If I look, however, at the sentiment data, but also some of the hard data, real retail sales in the US and sentiment indices, consumer sentiment, business sentiment, it's really at the low side. So we still expect contraction and recession. Actually, we do believe now we're probably in a recession already in Europe. So inflation recession, that hasn't changed, but there's definitely nuances, and it's better in terms of growth. We see that the fiscal spending in the US, that's something of last year in the US, that has put cash into consumers and they are spending. And in Europe, what we are seeing is a lot of fiscal stimulus to support the households and businesses. I just want to give you one statistic. Think about that. In Germany, who would have thought 1 year ago that German government is going to support businesses and households in the order of a little bit more than 7% of GDP? And that's supporting the figures. So that hasn't changed. And inflation, we just saw today's print, euro area print, a little bit better than expected at 10.0%. However, it's still 2 digits. And on the other side, it's the first decline we have been seeing since 17 months. So that's the good news. So what do we take out of all of that in terms of interest rates, which are important for us, right, as an insurance company? What's happening on the inflation front? Inflation, we do expect inflation to come down. However, it still remains sticky, and over the medium term, inflation also remaining high structurally. On the interest rate, we do expect central banks to continue hiking. So we are not done yet in terms of the central bank race to regain price stability. Probably the jumbo hike that everybody expected from the Fed and the ECB of 75 basis points going into year-end might not happen. Might still happen at the ECB, maybe less so at the Fed, but direction of travel for policy rates is still clear. It's going to go up, while probably at the long end of the curve. For 10-year rates, we have seen the peaks as just mentioned. Maybe just my last point and I close. And you see it in the title of the slide, the great moderation, it has ended. What does that mean? That means the last 10 years, the last decades of low to negative rates, of low macro volatility, financial market exuberance, that's something which is of the past. So that still has ended, and probably is also good, right, that the risk-free rates have recalibrated. But I think we should also be ready for a rough ride in terms of the macroeconomic developments. good news where we are today that consumption is holding up, but current indicators and the real economy, it's weak. It's going to get cold out there.
Thank you, Jerome. Thank you. So inflation still writ large, possibly moderating, but still writ large. So, Andreas, what are the implications of this for the insurance industry?
So if you think in headlines maybe for a moment, what headline would you see? Inflation raises claims cost and undervaluation of assets. This is front and center of every insurance company at the moment. We see it with the in-force book in particular. So claims costs went up, and in particular lines of businesses like property or like motor, physical damage. Here you can see spare parts, car spare parts, the costs going up tremendously in property, construction. Costs go up. Just to give you a sense of feeling for numbers, 40% is the steel price went up 40%, aluminium went up 160%, and this is year-on-year comparison, March 21, March 22. So I think that's sort of the liability side of the balance sheet. If you go to the asset side of the balance sheet, that's the flip side. So you will see that reinvestment yields are actually also going up. So you might see a good guy, a positive on the return on investment. But unfortunately, it always has a lag. It takes time till it's coming through. It also depends on the duration of your asset allocation. So I think that's what we see at the moment. And so there's no autopilot at the moment. You got to be very reactive. Got to be close to markets. And I only spoke about the in-force book. You also obviously have to look at the future book, the new business, and you have to price in all the inflationary effects that you were talking about. So. Rough times and see how markets are reacting to this.
Thank you. So premiums, Jerome, going up now. Just tell us what the implications of this are for the global primary insurance premium outlook.
Mm-hmm. Well, thanks for that. So in terms of the implications for primary and global insurance markets, and you see it here in terms of statistics, and more you will find in the Sigma outlook. I think bottom line message is the total premiums in 2022, and it's soon coming to a close, but still it's good to know where we are today, and it's super important to differentiate the nominal growth, obviously in times of high inflation, and the real side of the story. And fact is, if you look at our figures, we expect total real premiums growth of insurance markets, premiums earned in the direct insurance business, to be stagnating. A slight fall of 0.2%, but it's really a stagnation. I think more interesting is the momentum, the path ahead. And the path ahead is next year, probably real terms, below trend growth, if you look at both life and non-life, while it will take probably 2024 that you're going to see above trend growth in terms of global direct insurance market premiums. Well, I think Andreas mentioned already, but just to underline, and also based on the latest data out there for non-life insurance premiums, there we see the most impact, in real terms, on personal lines and on life insurance premiums. And you see it here also. There's a wide difference, and you see that Asia Pacific is most impacted, sees most of the decline, EMEA not far behind. But clearly, on the life side, it's a strong inflationary headwinds, it's decline in purchasing power for consumers, which is likely going to see a stronger contraction. And we expect 2022 to see a contraction of the life insurance premium growth of almost 2%. But again, momentum is definitely on the high side as inflation comes down, and then you have also opportunities. Maybe the bright side, just to mention that, I think the bright side is still emerging markets, where we still see most of the growth. And also North America is growing pretty strongly, 1.5%, and this also in real terms. So bottom line, it's a differentiated picture. You need to really look at the regions. But yes, it's important also to differentiate the nominal from the real one, given this extraordinary inflation pressure that we see.
Mm-hmm. Mm-hmm. And Andreas, so pricing and reserving are a challenge, I guess, in this inflationary environment. Tell us a little bit about that.
Well, I just was referring to the in-force book, and I think here you've got to read the claims trends, and that's what we always say, call the actuals that are coming through. And here, The number one item is obviously to look at the claims reserving, the case reserving, and then also at the IBNRs. And that informs, basically, that's the trend that informs the pricing actuaries who look at the costing and the pricing tools. And I think here you can see that circle, that loop that closes then, because ultimately you will see a nominal increase, as you said, in premium, definitely, because it's coming through, inflation is coming through, but in real terms, it's still hurting. Yeah? So reality is inflation is there. So that's the reality on the pricing side. But you can look at various angles. One thing is also to have strong capital management measures and risk management measures. Repricing is one aspect, and looking at reserves another aspect, yes. But you also got to look at the strength of your balance sheet, protection of your balance sheet by having adequate reinsurance protection. I know it comes at a higher cost at the moment because reinsurance rates are going up, retention levels are pushed up, and also there will be discussions around the most loss-prone areas in the business. Cat in particular is one area that we were talking about. So that's all coming our way, and you might have a bit of hedging opportunities maybe on the inflation side, but I think the reality is you have to use all levers almost at the same time to see that you maneuver through the situation.
That's great. And how can the insurance industry help corporate customers during the hard market?
Yeah, I believe you can look at rate increases, as you said, and there will be a point at which customers will decide whether to still risk transfer or to look at self-financing, risk financing solutions and funding solutions for themselves. Captives is one instrument here. We see that in the hardening of the market, a lot of people look or revisit the creation of a captive. We have introduced an instrument called a virtual captive, so that mimics a captive using our balance sheet. So that gives corporates the opportunity to already today use the instruments of a captive without having a physical captive, a licensed captive, and they can then take the time to license a captive over time, or maybe stay with a virtual captive. Yeah? So that's one aspect of it. Parametric solutions is another one, and that's becoming very, very popular. So it starts with the larger end of the market, the large corporates who have these strong balance sheets themselves and who then decide, am I still willing to pay this rate increase, or am I going to go for self-risk financing solutions where we can also help them as an industry?
Okay, thank you. Let's cast our eyes forward now a little bit into 2023 and 2024. Jerome, I know you've got some scenarios for us to look at. Just tell us a little about the outlook.
Yeah. Super, no, thank you. And for us, Anthony, it's super important to look at the scenarios. And I think this is also something where we can help also, obviously, our clients sharing the scenarios, because fact is the world is super uncertain. There's lots of uncertainty. We're going from one crisis, COVID, which was systemic, to another crisis, and the world is changing. So let's be mindful. It's very difficult to predict the future, right? So that's why let's not just think about the baseline, but also about alternative scenarios. And this is something we are doing extremely rigorously at the Swiss Re and the Swiss Re Institute. We're developing these scenarios, and they flow into our sigmas, and they flow also into the steering for us internally, but then also we share it with clients. And here you see the big picture, the alternative scenarios. Maybe the first big picture is and takeaway in terms of distribution of risks. Actually, we still do believe that the risks are tilted to the downside. Now, our baseline scenario, inflationary recessions, is not a happy one, right? And on top of that not happy one, we still see the risks to the downside. What are they? They are the really structural stagflation period, similar to the 1970s. I really do believe this is a very remote risk, because 1970s you had very much different economic characteristics. You had unions. You really had wage price spirals. You had the Fed needing to go and hike interest rates well above 10%, and you had persistence of double-digit inflation. We are not seeing that today. I don't expect it. However, it's something to keep in mind, and that's why we also look at the narratives and the signposts, wage price spirals, persistent supply disruptions, or the fiscal dominance or loss of central bank independence, which would be signs for us to say we are really moving into that scenario. But again, that's not what we expect. Severe global recession is, in our view, the number one downside scenario to watch. And yes, Ukraine war, that's a huge stagflationary shock. It's a commodity price shock. Now, it's good news that we had seen the warmest October. It's good news that we have the gas tanks, the gas storages in Germany almost full. But what about the next winter? And obviously, the hurtful geopolitical developments, these are all external factors, and they all need to be monitored extremely closely. And also what needs to be extremely monitored closely is how do the tightening, the unprecedented tightening that we are seeing from the Fed. I mean, let's just for a second think about that. The Fed tightened this year by an amount which is unprecedented, and we do expect the Fed will continue tighten next year, probably above 5%, and risks being that they will tighten even further. And we had seen lots of market volatility, especially in the UK. We wouldn't have thought we're going to see with the fire sales of sovereign debt in the UK. So there's a lot of leverage in the system, and maybe it's going to take longer, right, until you see the ripple-on effects. But anyway, severe global recession is number one to watch. Let's also be looking at the other side of the tail, which is an optimistic scenario, and I think there's also reasons here and there to be more optimistic, right? I mean, one thing is the real economy has weathered the interest rates pretty well, and that's good news. However, it would need really geopolitical de-escalation and stability, in my view. It would need a program to spend and green our economies to an extent I think we are not seeing yet, but it is possible. Maybe this crisis is going to be a wake-up call. For us, this is the golden 20s scenario. We attach a probability of 10%. I mean, one thing is the economic narrative and the economic signpost. The other thing is obviously what does that mean for markets, and you see it here. For markets, could be extremely disruptive if you have a severe global recession. But for an insurance company, and I think for our industry, Andreas, right, it's the structural stagflation scenario which is really the worst. But again, I don't think we are there, and I don't think we're going to get there. But I think this scenario monitoring is really, really central, because at the end of the day, it's about the accumulation of risk, and we are in the business of pricing risk.
Brilliant. Well, thank you, Jerome. Truly interesting times. And Andreas, I'm going to come to you in just a second, but I just wanted to remind the audience that if you'd like to ask a question, please just click on the Q&A icon. I think there's a question mark in the top right-hand side of your screen. Please just click on that and put in your question. We're looking forward to receiving those. So, Andreas, inevitably, your reaction then on the scenario. So 3 quite different scenarios in front of us there. How does that seem to you as the chief executive of a business?
Well, scenario planning is the rule of the game at the moment. That's what you have to do. You were describing the scenarios. What we do, and we do it more and more also with our corporate customers and also brokers, we tell them, you got to create a digital twin of your reality, of your assets, etc. And that's exactly what we do here internally. We take our portfolio as it is today, and we say, let's create a digital twin or representation of that portfolio and then stress test it with exactly those scenarios. And how does the portfolio behave? And it informs then the actions that we will take, or the planning that we will take, the individual growth areas or reduction areas that we have to go through. And I think that's an exercise that's very vital for us. Our plans are based on exactly those scenario plannings. Again, we look at also the probabilities of those scenarios, what is probable, what not. And I must say, it's an exercise that is not a typical exercise that we did over the years in the industry. So I think we're doing it now. More and more corporates are doing the same thing, because everybody was pretty much short-term driven, reactive. The markets were hot. Everybody was making good business. And then through the disruption of the supply chains, etc., coming through the crisis that you were mentioning, Jerome, corporates were starting to think, in particular suppliers to OEMs, etc., who really feel the pain, and that's what we can contribute, and our teams ourselves are also learning from those scenarios. I can always say it can turn very quickly, so you got to be very reactive very quickly in order to change course if the external factors are changing again. But here the instrument helps scenario planning.
Thank you. Thank you. So again, just click on the icon on the top right-hand side of your screen, if you can, please, to ask any questions, and we'll get to those in just a moment. Jerome, a question here for you from Michael Munch. Do you see protected cell companies in jurisdictions like Malta, Luxembourg, and others becoming more popular due to the current economic or fiscal situation?
Okay. Yeah, maybe I provide my perspective if you want to add.
I can add afterwards, yeah.
I do think it will become more attractive for a number of reasons. I mean, it's already alluded to in the question, right? Because of the protection needed and the regulation that is being provided in these areas. Now, do I see this as a super growth area? Probably not, but I think in a world where you have a deglobalization, in a world where you have fragmentation, structures which are more regulated, which are more national, I think they are, just relatively speaking, more attractive. Yeah, would be my perspective.
Mm-hmm. So, if it's the Michael Munch that I know, hi Michael, a very good question. I personally think corporates, in particular the larger corporates with a stronger balance sheet, they are assessing various situations in their feasibility studies, and cell captives is definitely an instrument that people are very interested in. But I'm seeing a lot of interest also in this virtual captive concept, and for good reasons, because you don't have the cumbersome internal built-up phase, because it has to go through decision processes. You have to negotiate with regulators. You have to incur costs, in order to build up those captives, and cell captives and rent-a-captive concepts can help. But the virtual captive can help immediately, because it is actually using a strong balance sheet, mimicking the instruments of a captive. So that's sort of the learning from the past, probably 12 months. We have seen a lot of interest in Asia Pacific, interestingly also, but also in the traditional insurance markets, Europe, but also US.
Okay, thank you. Next question is, to what extent, Jerome, might we see a serious liquidity squeeze in 23-24?
It's a super question. Honestly, if you would have asked me 1 month ago, I would have said it's really a non-negligible risk going into the year. And I think 1 or 2 months ago, when we had all the troubles, right, in the UK with sovereign debt, seeing a fire sale, that was on the top of the mind of people. Are we going to go into the year end with liquidity stress, maybe even in the treasury market, in the US treasury market? So, but the question was actually not into the year end, but next year. I think it's something to be really mindful about liquidity stress. We also look, and it's also in our Sigma report, in the Outlook Sigma report, we look at the financial stability metrics within the US. Now, fact, it's not flashing all red. However, equity market volatility is high, interest rate volatility is as high in the US as it was during the global financial crisis. We see more technically within the treasury market, on and off treasuries, price differentiation from time to time. We see emerging markets having been under stress. However, fact is, over the last month, we had seen the rally. I think it's a bear market rally, so that's why 2023, I think we should be extremely alert in terms of liquidity risk, and liquidity risk probably there and in instruments or in the sectors where you have a lot of leverage. That's probably in the non-banking sector. I think banks are pretty healthy, at least from a balance sheet perspective, and they've also compared the metrics relative to 2008. So I think it's something to be mindful, and I don't put a low risk to liquidity risks in 2023, especially in non-banking industry. I think we still have to see, given the amount of interest rate increases, how this spills over into the real economy or then in certain financial market asset class, including leveraged loans. So,
okay. It's very interesting here, Andreas, on the consumer's wallet and how will the insurance industry remain relevant in personal lines with cost inflation, bringing clients to consider which insurances they'll still have money to spend, giving a trend towards focusing on compulsory only. How do we keep the product?
I think it's a myth that insurance is becoming irrelevant. Insurance is part of society. And the importance of insurance in a given economy is enormous. You'll find insurance all over the place. And the reality is that if you look at economic losses all over the world and then the insured losses, you definitely see a protection gap. So that to me tells me there is a relevance for insurance. Now, how can we make it easier for consumers or more attractive or appealing to think about insurance? I think there's some homework to be done. I think on the personal line side, we have seen very, very strong pushes into that direction where we really understand the customer needs and can also embed insurance in traditional purchasing of goods. So that's a trend that we see is going to increase definitely. By the way, you will also see a spillover into the corporate and commercial insurance space because I believe you will see more embedded insurance with predictive underwriting in software, in machinery software as an example. And there are some very good early examples, proof points for this trend. So I'm all for it. I personally think we have to invest into it and test out.
Maybe if I can add, I would totally agree with what you say, and also from a macro perspective, I think these crisis times, one systemic risk after another systemic risk. Now we have used the public balance sheet yet again in Europe, right? I mentioned 7% plus of fiscal subsidies to households and also businesses in Germany. I mean, this tells you something probably next time we won't have that fiscal buffer in place, which means we need to make sure we have better insurance, not just coverage, but penetration and also public-private partnerships in place. Resilience, I think, is really the key word here. We need to improve the resilience of our system.
Yeah. What we need to find is really the answer to the emerging risks that people today believe are uninsurable. And I think data, it's only data, and the capability to model. Then I think we can find solutions also for the upcoming more cyber-related exposures that we have. So that's a journey that we're on already, but I think there's a lot of more homework to be done here.
Mm-hmm. Okay, that's great. Well, gentlemen, thank you very much indeed. I think we've already reached the half-hour spot. We give ourselves a tight slot just to keep it within sort of meeting timings and to keep it as essential as possible. So, thank you very much indeed for tuning in. Thank you to the audience. Thank you to you both for joining us today. We will send a copy of the recording now to everybody who's attended, and that will include also some additional information, other publications that you can look at as well. So, from us here in the studio at Swiss Re, thank you very much indeed for watching today, and we look forward to being in touch. Bye-bye.